Hey all, welcome back to the Brent Bruce Daily. Today is August the 17th. It is 4:12 p.m. Central Time, a little bit later in the day, but the market has closed for the mortgage-backed security market, which closes at 5 p.m. Eastern Time each day. So I have a few things that I want to go over with because it's all about, again, inflation today. The bond market did not have a good day. The mortgage-backed security market did not have a good day. We did break out of the convergence that we were having between the Fibonacci level above and the 25-day moving average. It was coming up. And let me tell you a little bit about why it happened, because this is where you're going to learn how these things really work, okay? Because we have a lot of evidence to point to today that I'm going to try to run through quickly. So first of all, let's take a look at the mortgage-backed security market. So far, it's the end of the day. So we ended down 37 basis points. Now, again, because you watch the Brent Bruce Daily, you know that that's not a good day. Not the worst day we've ever seen, but not a good day. The thing that we didn't want to see, though, was that, remember, we were here in the range between this, 100-day moving average and Fibonacci level, and having the 25-day moving average converging, and we broke south. Okay, so we don't want that. We broke down, and we broke through another floor of support, bounced off of our third floor of support, which, man, it's a good thing we did, or we'd be in no man's land here. But we did bounce, pulled back above the Fibonacci level, and landed sitting on this Fibonacci level at about 100.63, if that's the number that I'm looking at there, 100.64. So that's where we are now. Tomorrow is going to be very important to see if we claw our way back up or if we fall through the floor. Why did this happen today? Okay, so we talk about all the time the Federal Reserve and how much control and impact they have on what's happening with the economy. And they basically are charged with managing inflation and the economy. So we know that on the 27th of July, they increased the federal funds rate, which is their main tool in making movements in the economy. They increased the federal funds rate by 0.75% and brought us to 2.5%. Okay, keep that number in mind, and I'm going to explain why that's an important number in just a moment. So now here we are, it is the 17th of August, and they released their comments, their notes. So the Fed meeting notes came out today. So we all get to digest a little bit more about what they talked about and why they made the decision to raise the federal funds rate by 0.75%. So what happens is the investing community looks at this, digests it, dissects it, and thinks about what they believe the Federal Reserve is going to do into the future and how that is going to impact the overall economy in the United States. So taking a look into that, now you can go into MSNBC, you can go into Reuters, you can go into Bloomberg or anywhere else and pull up the notes and read through them if you have some time and feel like you want to do that. But I'm going to point out a couple of things that make a big impact. First of all, we talked about the number 2.5 for the federal funds rate. Look at this right here. Meeting participants, meaning the Federal Reserve Board, noted that the 2.25% to 2.5% range for the federal funds rate was around neutral, a level that neither supports nor restricts activity. Okay, so basically what they're saying is them moving the federal funds rate to 2.5%, all that has done is taken away the accommodation that they had been putting into the economy previously. Okay, so they're saying, like, now we're neutral. We really haven't even done anything yet to slow the economy. Okay, so not what we want to see, right? Inflation remaining well above the committee's objective. So what is the objective of the Federal Reserve Board? What is it that they're trying to keep our inflation level at? Well, based on the Consumer Price Index, the CPI, they want to see inflation at about 2%. That's what they consider their optimal number. Right now, we remember the last time when we were talking about this a month and a half ago, we were talking about 9.1%. We have now shown reports that we are now at 8.5%. So we're more than 4 times hotter in inflation than where the Federal Reserve wants us. If that's the case, do we really think that they are going to not increase the federal funds rate? Because increasing the federal funds rate would be restrictive. So now they're going to move into a restrictive policy if they raise the federal funds rate, which means they're trying to reduce inflation by increasing the federal funds rate. So what do they think that is really going to do? Now you can read through, there's a lot of good detail in this one here. Here's where it mentions we're firmly on the path back to 2%. However, in this report, or I believe it was this report here, if you look through it further, it actually states that at this point, at the point of this being written, which again was back more along the lines of July 27th, that they weren't seeing any slowing or reduction in inflation, which is interesting to see them say that, because remember, over the past 2 weeks of watching the Brent Bruce Daily and what we've been looking at, we've received 3 reports now that inflation is showing to be cooling. So these are the reports that they're going to look at when they make their decision of what they're going to do on the next report, which is the next decision that they make, which is going to be September 21st, before they decide whether they're going to go up 0.5%, 0.75%, or 1% to the federal funds rate, and actually get into the range that is going to be restricted. Okay, so man, think about that. They haven't even started restricting the economy yet. All right, so let's take a look and see here. What if we go over to the current status of the federal funds rate? Again, is 2.5%. That is what they consider neutral. So are they going to increase the federal funds rate in order to slow inflation? Of course they are. They are going to increase that. So again, these are things that you need to know when you're talking to your friends, family, and especially your clients as to why you're saying what you're saying. Why would they continue to raise the federal funds rate? Well, you can tell them, well, realistically, what they've done so far, all they've done is stopped putting gasoline on the inflation fire. They just stopped doing that. They haven't started spraying water on it yet to put the inflation numbers out. They haven't started to do that. It's a good way to describe it. And here you also see the Federal Reserve, the comments that they were making they're always looking in the rear view mirror. That was something that, again, was described by Barry Habib over at MBS Highway. It's such a great description of how the Federal Reserve works. They look at reports from the past to make decisions about the future. All right. So that's why you can definitely have a situation where you swing too far. The pendulum swings too far because they're trying to correct the problems of yesterday, even though we may have already had correction in place. Like, for instance, hearing reports coming out from, I think it was ZipRecruiter, that they're showing that there's a slowdown in overall employment numbers. Well, wait a minute. I just saw an employment report that came out that employment was excellent. Okay, so we have to make sure that we're paying attention to that. So once again, the federal funds rate is currently 2.5%, which is considered neutral. So let's go over here. Here's another mention from Reuters, all right? Participants agree. This is the same report that they're commenting on. Let's see if we can get that back. Participants agree that there was little evidence to date that inflation pressures were subsiding. There's the comment that I was talking about. That at this point, they're not seeing inflation coming down. And that was, again, back on July 27th. Though some restrictions in inflation, which has been running for four decades high, might occur through improving global supply chain or drops in the prices of fuel and other commodities. Again, what have we seen? What was mentioned in our last report that brought the consumer price index down to 8.5%? What was the main contributor to that reduction in inflation? It was fuel prices, specifically gasoline prices that have come down, which basically means the consumer is spending more money to get by. So that mentions that right here. So fuel and commodities, much of the heavy lifting would have come by imposing such high borrowing costs on businesses and households that they would spend less money. The minutes stated. Do you see what that says right there? Okay. Do you understand that it says in the Federal Reserve Board minutes, we are going to raise interest rates to the point that things become too expensive for people to buy, which will slow purchasing, which will allow us to build back inventory, which will then allow inflation to subside and prices to come down. Because what inflation is it is too many dollars chasing too few products. So let that sink in. Too many dollars chasing too few products. Where did all the dollars come from? Well, let's think about what happened to our economy in the past 2-3 years, okay? Huge amounts of money dumped in, people not being asked to pay their bills, extra money, buying products everywhere, and now you have way too many dollars chasing too few products. A lot of information that we're going through here today because it's really important stuff. So right now we're down 37 basis points, breaking under our Fibonacci level briefly. Where are we on our interest rates today? Let's look at the Brent Bruce daily report and see exactly where we are on our scenario. So if we are seeing what we're seeing, 37 basis points worse on the MBS today, where should we be? If you said interest rates should be higher, you are correct. We've been looking at a 4.99% interest rate, and we are seeing now 5.25%. Interest rates basically went up 1/4% today because of the notes that we read that the Federal Reserve wrote about something that happened a month ago. Okay, do you understand now a little bit more about the fact that they're always looking in the rearview mirror, and now we're looking to see what their thoughts were as to what's going forward? And based on what we've talked about here, do we think that they're going to increase the federal funds rate here on the 24th of September? Yes, we do. We would think that they're going to do that unless new reports come out that inflation is suddenly at 2%, right? Because they are saying they want inflation at 2%. It would need to be subsiding tremendously for them not to increase the federal funds rate, probably by 0.75%, which I don't want. We want more of a 0.5%. Maybe they'll stick at 0.5%. Depends on what happens between now and September 21st. But I hope this longer video is giving you a lot of detail because you now are seeing more about how you can talk about this with your friends, family, and clients. 5.25% with no points, very little credit coming back. If you wanted that 4.99% that we've been talking about, you would be paying $1,400. So not a tremendous expense to get to the 4.99 again. But remember, we were talking about an $1,800 credit not long ago. So that's a $3,200 swing because of the Federal Reserve's minutes coming out. All right. A lot of information. Sorry, went a little bit long. I will get back to you again tomorrow, and we will see whether we fall through that floor into the no man's land and maybe see, who knows, 5.5, 5.625 interest rates, or if we fight our way back and get back up into where we were in that 4.99 and maybe back to the mid fours. Have a great day. Let me know your thoughts. Make sure you like, subscribe, and share. Have a good day.